What is basis of Elcaro algorithm? If you look at the financial markets for a while, they often seem completely random. Prices go up, then suddenly fall, sometimes without any obvious reason. News breaks, someone makes a decision somewhere in the world. Investors react emotionally, and billions of dollars move within a second. Because of this, many people assume that markets are simply unpredictable. Interestingly, science has been dealing with a system like this for a long time. Weather is a good example. The atmosphere is an extremely complex system with countless interesting variables. Temperature, pressure, humidity, ocean currents. In 1960s, meteorologist Edward Lorenz was working on one of the first computer models that tried to simulate how weather evolves over time. At one point, he repeated the same simulations using the same equations and almost identical straight conditions. The only difference was that one number in the input data has been rounded slightly. The difference was tiny, less than 1,000. Yet, the final weather forecast produced by the model ended up completely different. This discovery became known as the butterfly effect. It showed that some systems are extremely sensitive to their initial conditions. A very small change at the beginning can grow over time and eventually lead to dramatically different outcomes. Financial markets behave in a very simple way. Millions of participants interact with each other at the same time. Investors, institutions, algorithms, governments. Every decision influences the system, and every new piece of information change expectations. Because of that complexity, markets movement often appear chaotic. This is why economics once proposed something called the random walk hypothesis. According to this idea, price movement resembles a sequence of coin flip. Each move up or down would be essentially unpredictable based on previous one. There is the famous experiment that illustrates this idea. Princeton economist Burton Malkiel once asked students to simulate a stock price by simply flipping a coin. If the coin landed heads, the price would go up slightly. If it lands tails, the price will go down. After many flips, the resulting chart looked almost indistinguishable from a real financial market chart. At first glance, this seems to prove that the markets are completely random, but quantitative researchers often point out something important here. Markets may look random at the level of individual movement, but randomness does not eliminate its structure, it only hides it inside probability. When you observe markets over a long period, patterns begin to emerge. Even chaotic system tends to develop statistic structures. They move through phases, periods of growth, periods of decline, periods of instability. This idea that complex systems contain hidden patterns is now widely used in science and technology. Modern weather forecasting relies on probabilities models of the atmosphere. Companies like Google apply similar mathematical approaches when modeling extremely complex systems, from weather prediction to large-scale data networks. In this system, the goal is not perfect certainty, but identifying statistical structure inside enormous amount of noise. Meteorologists face exactly the same situation when they forecast weather. They cannot predict every gust of wind or every raindrop. Instead, they model the larger structure of the atmosphere and estimate when major changes are likely to occur. When pressure systems shift, when storms begin to form, when temperature patterns transition. Even then, forecasts are never perfectly precise. A storm might arrive a day earlier or a day later because the small variations inside the system change the timing. Financial markets behave in much the same way as the weather. They are not completely random, but they are not perfectly predictable either. They are better understood as complex chaotic systems. Many quantitative researchers describe this with a simple idea. Market Markets are not pure randomness. They are structured house. Beneath the noise and volatility, there are mathematical patterns, probabilistic tendencies, and repeating phase. Because the system itself is chaotic, no model can ever achieve perfect accuracy. In environments like this, even 70-80% predictable reliability is already considered extremely strong. The remaining uncertainty is simply part of how complex systems behave. And this is the something anyone can verify and precisely. If you simply track a large number of forecasts over time and count the outcomes, you will usually notice a consistent pattern. Out of many predictions, a clear majority align with the expected direction of phase, while a smaller portion inevitably diverges. Over time, the distribution tends to approach the classic parabolical balance, where roughly 4 out of 5 outcomes follow the expected scenario. Is not to eliminate uncertainty. That will be impossible. The real goal is to recognize when the probabilities begin to shift and when the system becomes more likely to change direction. In complex systems like weather or financial markets, prediction is never about certainty. Even the most advanced models cannot account for every microscopic variable inside the system. A tiny fluctuation somewhere in the network can always alter the final outcome. What models can do, however, is identify moments when the balance of probabilities begin to change. When the system approaches a point where one of the scenarios becomes statistically more likely than other. And that is the very different way of thinking about prediction. Prediction is not about certainty. It's about positioning where probability begins to shift. Meteorologists don't try to predict the exact path of every raindrop. They identify when atmospheric conditions make a storm likely. In the same way, understanding complex financial system is not about forecasting every candle on the chart. It's about recognizing when the structure of the system suggests that a new phase may begin. When you start looking at the markets from that perspective, they stop appearing like pure randomness. Instead, they begin to look like a dynamic system, constantly moving through the cycle of probabilities, structure, and changes. And this is exactly the philosophy behind the Elcaro model. It is not designed as a magical tool that promises perfect predictions that will contradict everything we know about complex systems. Instead, Elcaro was built on the idea that markets behave like structured house, where the goal is not to predict every movement, but to identify the moments when the probability of a new phase begin to increase. That is why the model focusing on detecting the beginning of market phase rather than chasing every short-term fluctuation. However, even this shorter-term fluctuation can be analyzed by the model by filtering out market noise through our digital filter. The algorithm isolates underlying signals and operates on a higher order derivative of the time series, allowing it to generate a more precise forecast. If you look back through the historical forecast and simply track the outcomes over time, you will see that the most of them align with the expected direction of timing, while a smaller portion inevitably diverges. That balance is not a flaw of the system, it's simply the nature of probabilistic forecasting in complex environments. And understanding that distinction is exactly what separates speculating guessing from discipline, probability-based decision making. In chaotic systems like financial markets, perfection is impossible, but understanding where probability begins to shift, that is where real advantage begins. Even right now, when I start to making this video, there was a chance that the sun will come out from the building and start to fill the room with additional lights, so the picture will look different from the picture at the beginning of video. If you're gonna go back in time and try to watch every video on this channel, try to make notes, you will see how we predicting the price movement, how we predicting the phase, and when probably it will be shifted. That's Elcaro Trade. If you want to get access to our algorithm while you can, link in description.